we'll get stuck right back into our final panel of the day. So the signal and noise, the blockchain value in the business of re/insurance. So let's, without further ado, I'll introduce lovely panelists for our last session of the day. So directly beside me, we have Greg Hofnagel, Special Counsel over at Cooley LLC. So Greg's practice focuses on complex insurance and reinsurance disputes, as well as international commercial arbitration and litigation. In addition to his dispute work, Greg advises insurers, insurtech innovators, venture capital firms, reinsurers, retrocessionaires, brokers, TPAs, and MGAs in compliance, regulatory, and transactional matters. And a really big part of his advisory work involves insurtech, along with VCs and insurance carriers, creating innovative products, bringing them to market quickly, choosing an operating structure, and then over to the licensing and regulatory side. Next over, we have Vikas Acharya, co-founder and chief operating officer of ChainThat. So Vikas is a technologist by background, has extensive experience designing, delivering award-winning market modernization and enterprise solutions to commercial insurance and reinsurance industry, including the Lloyd's market. As a startup enthusiast, Vikas has mentored and advised several newly established businesses, both in Asia and in Europe as well. Next over, we have Ari Chatterjee. Ari is the CEO of newly launched Envelope Risk Analytics, was responsible for underwriting and insurance product development. Prior to that, he was responsible for underwriting cyber reinsurance Hanover Re in Bermuda, a line of business he helped them develop. Beyond cyber reinsurance, he's also underwritten marine and energy, property cat, credit and surety, intellectual property, and motor deals, and he's 14 years of reinsurance experience. And then finally, we've been able to get lovely Tom Graham, managing partner at TLDR, the crypto advisory firm and hedge fund, presence in London, NYC, San Francisco, Tokyo, and Hong Kong. They're a trusted advisor to many top 100 tokenization projects and an innovator in crypto finance, from token generation events to publicly listed funds. Tom was previously a visiting scholar at Harvard Law School, focusing on the intersection between social networks, big data, and law reform. Lived in China for many years, speaks Chinese, and also used to work as a US capital markets attorney in Hong Kong, and originally from Melbourne. Welcome, one and all. So for our last bit, we're looking at how we're actually going to get blockchain into the real world. It's all well and good sort of talking about this on a conceptual level. It's an interesting thing to do, but to try and actually get this into real world, there are an awful lot of hurdles to overcome, no less anywhere than on the legal side of things, Greg. I'm sure this is, when you're talking about blockchain in your circles, that it comes up a lot about, this raises a lot of interesting new questions about how this is going to be dealt with from a regulatory perspective, how it's going to lead to different new types of legal disputes. What are the real questions that are coming out there?
Good question. Well, one, someone might say, well, we have a U.S. attorney here speaking on blockchain. What do we need him for? And you might be right. But one of the things that I'm seeing in the space as compared to Bermuda, where they're setting up a sandbox, is, as many people know, the U.S. is a 50-state or 51-state regulatory regime. So you're not just working with one regulatory body as you start implementing some of these technologies, but you're working with 50 regulators. And so that alone is just going to cause a tremendous amount of stagnation in trying to get this done. What I am saying, and someone was saying before, when we have had clients, whether, and the term gets used a lot now, traditional insurers, or the insurers that everybody knows about, as compared to some of the startups in the spaces, regulators in the US get sensitive regardless of what you're doing when you start having things that influence underwriting, when it influences claim handling. So if you're using blockchain, and it might be improving your internal processes, you're going to need to get the regulators on board, and you're going to need to have them understand exactly what you're doing, how this is working, and then why this still is regulatory permissible. And so that is the real challenge that I'm seeing with my startup companies that are trying to get into this space. But I also advise some VC firms, and VC firms that are investing in this space will say, this is great. We think this is a great company. It has a large application. The traditional carriers are seemingly interested in using it, but are the regulators going to get on board? And I think for us in the United States, that is a kind of choose your own adventure. Some regulators seem to be more inclined of embracing innovation. And then if you come to my home state in New York, where you have the DFS, that's a whole nother ball of wax. I mean, the DFS has an attitude that they don't really need to bend for anybody. You bend for them. If you want to operate in their state, you'll do it how they want you to do it. And so they've been really reluctant, and I'm not even specifically talking about blockchain, but just the embracing technological changes in this space. And so that's, I think, a real practical consequence that carriers, startups, and third-party providers of blockchain or different technologies if you're going to operate in the U.S., are going to have to reconcile. And it's going to be something that, again, it's not going to happen overnight, and it's going to be a timely process.
Thomas, it must be something you see a lot of when you're advising your clients is how do we actually, whether they be a blockchain-based platform or whatever it is, how do we actually make it sort of all compliant and all sort of above board? What do you do when your clients are coming to you, or what do you tell them when it comes to this?
Absolutely. So at TLDR, the first thing that we don't do is give them legal advice. Engaging counsel wherever they happen to be based, wherever they're looking to sell tokens, is the very, very first step. But what you find generally is right now in the market, there are hundreds, thousands of companies trying to go through a tokenization process. Very few of them are trying to do that in the United States right now. You might have, and we have a lot of clients who are venture-backed US startups, maybe Series B, Series C kind of companies, and they are in the process of doing a reverse ICO or trying to create a new product that can have a token and facilitate a new business model. They will have their home company in the US, and they will have an issuance company outside, maybe in Cayman, Singapore, Malta, Gibraltar, somewhere like Bermuda, a variety of different jurisdictions which are a little bit more friendly and a little bit more permissive. The US is very, very difficult to navigate, not just at the issuance phase when you actually create the tokens, or through the sale phase when you try to sell them to somebody, but through the process of that rabbit hole that makes those tokens begin to look like securities, which is, say, the listing process, or putting those in a pseudo-public market, something like that. So we rarely now work with US-based issuers because they don't really exist so much, because it's very, very difficult to move ahead. And so there haven't been that many fantastic success stories where people have issued out of the US in the last year or so. You do enter into another weird paradigm when you go to these small jurisdictions and you're issuing out of one of those. And that is proximity of regulators to your lawyers, your advisors, maybe your fiduciary who's sitting on the board, and your entity that's doing the issuance. So when you can literally go and ask for regulators, people are really inclined to do it. And so that can be frustrating in that it normally takes time. Not like a long amount of time or anything like that. It's just a weird thing to come up with a novel structure, and then the lawyers are like, we'll go and ask the regulators. And they're like, no, wait, can we just make an assessment of a risk inside the legal framework as it stands and move ahead? And they don't want to do it. So that's pretty much the lay of the land right now in terms of pushing, launching these token projects. I would rather be in the small jurisdictions where you have some certainty, where they've rolled out a set of laws or a set of frameworks and there's some certainty. Also being able to speak to regulators, that's great. We try to speak to regulators everywhere we can, as frequently as we can, because regulation is already here and regulation regarding tokenization is coming. That is undeniable, and it's fantastic for the industry, fantastic for the economy, and great for all of the projects who are trying to do really special and interesting things in the innovation space. And I'm talking mostly here about utility token projects, trying to find new ways to build business models, new utility, opening up new markets, providing a franchise for a different group of people to participate in the rewards of that economy, rather than, say, people who run venture capital firms in San Francisco. So we are 100% for regulation and try to facilitate that wherever we can.
And so sort of moving on a slightly different note, I wanted to ask URI, because you guys have just recently started up, right? And you're doing cyber reinsurance insurance. This is just, this is right in the cutting edge from an industry perspective. When you're looking at the tech to help you guys underwrite effectively, where is blockchain on your list, and of the sort of different things that you need to be able to do to underwrite effectively in the way that you guys need to?
So one thing good about us is, like, since we're a startup, we don't have any legacy systems to worry about. So we don't have to scrap our previous systems to move to a new system. So we are trying to build a future-proof system which can actually operate in a blockchain environment. And on top of that, I think that's a very interesting point that you raised, that how does underwriting and blockchain kind of can sit together. And I think underwriting, blockchain, and when you include artificial intelligence in the equation, or together they become a kind of a blueprint for the future reinsurance firm, where almost end to end the whole process, at least if very large part of the process can be automated, right from when the deal comes from the broker to the underwriter at that level itself. I mean, if the deal is already a renewal deal, then you already have quite a bit of intelligence and data on that deal. So it's not a very difficult task to actually build algorithms that would be able to underwrite at least a large part of that risk. So kind of what we are trying to build is kind of an augmented intelligence where you have both. We are not cutting out the humans by any chance, simply because humans have a different level of abstraction, which is very difficult to have in an AI environment. So human plus AI is definitely superior to just AI or just human. So essentially what we are trying to build is to the extent that we can automate cyber risk cyber insurance underwriting, we will do that. And when blockchain becomes a bit more, what to say? I mean, it's already there, but I don't think wide-scale adoption has already taken place in the industry. So we're waiting for that time to arrive, at which point we probably will go that route.
Can I just jump in there? Just to set this context from a little more as to how practical blockchain is, as you said, it's there right now. We in ChainThat, we started blockchain in insurance three years ago formally, but much before that. What we have is a mature platform that allows the reinsurance brokers and carriers to try out the benefits of different aspects of the use case, be it a claims, underwriting, placement, accounting, settlement, workflow. We have already pre-built some of these components. The key reason is, in the panelists before, we mentioned about a huge IT project to try out a big blockchain project and fear of failure. In order to avoid that, what we did was we wanted to build a platform that allows the innovation journey to be faster for both the reinsurance brokers and the carriers, everybody to try this platform. It's just technology is enabled by blockchain, but there's lots of other suites of components that we've built which blockchain can't solve into this insurance framework that we've come up with, which is exactly to make the operations faster, slicker, and quicker. And if you want to see the live demonstrations of some of this, we have it today, and we can run some of the use cases, and it just put the context that it is there, ready to be configured, to be taken on, and be into production. I'm sure BUEI have shown that with the Maersk solution, and it is happening. It is in production. It's a production-ready platform. We're happy to come and meet you and show the demos if you guys are interested. So just jumping in.
That's good. Go ahead, go for it. Sales page, always welcome. Okay. Could we just come back to you, and you've been advising a lot of insurtechs, a lot of blockchain-based companies when it comes around to this. What are the sort of problems that they're coming to you with? What are the primary things that sort of keep them awake at night?
Well, the pure startup companies are, because they come to me somewhat as working in the insurance industry or working with carriers for 15 years, is help us help them to communicate with them. Sometimes it's just simple a communication thing. I think you're saying like use cases or applications, but trying to get the right people at the carrier side, the right buy-in, and also to try to get them to understand how this could be implemented. So, we talk about use cases, whether it's oftentimes, I know this from my own experience that I kind of add value to. I see in the reinsurance space for 15 years, I've made a career, and I might be actually hurting my career with this, but of just the disputes that have come out of the inefficiencies in the reinsurance space, the lack of communication on a large treaty workers' comp when you're trying to do audits or you're trying to collect information and you're trying to say, find this truth, and you're basically just digging for documents. And in a reinsurance arbitration, if you're looking for one truth, the one thing about a reinsurance arbitration is there's usually 2 or 3 versions of the truth because you have spotty documents, a number of years have gone by, and it's basically create your own narrative. So one of the areas that I've always seen is, I actually think of a number of the use cases, the reinsurance space of like cutting down on your legal spend in the back end would be huge. But also, do you just think where the reinsurers sit or the retrocessionaires sit, you're so far from the actual underlying liability, and then it gets passed up to the cedent, and then it gets passed to the broker, then it gets passed to the reinsurer. And when you actually have to get behind the scenes to try to figure out what's going on, like I said earlier, it's basically you might as well just create the own narrative because the documents are spotty, the truths are spotty, and sometimes these losses happen years later. So one of the ones I'm the biggest proponent for is, sometimes say this is a solution looking for a problem, but there's a problem in the reinsurance space of how it works. Like I said, I've made a career out of dealing with these problems, but there's a whole cottage legal industry out of there that kind of really focuses on these issues. And I think this is one of the areas that I at least instruct my clients to is, if you're going to be speaking to Everest Re or these reinsurance carriers, talk about these points, because this is where they're spending a ton of money year in and year out that I think could be a very good fix with using some sort of blockchain apparatus to try to tighten up the reinsurance space.
Yeah, I think I think we're working with one of the brokers where actually the auditability of actually who said what, when, what context, and it was underestimated before because they were throwing people at it for data discoverability, but it costs so much time and money to land on that. Sometimes you wonder it has to be so ambiguous, just get around it. But actually in blockchain it creates that immutability history of transactions, which is the business transactions, which you can't erase, which is good to know.
And so from the point of view of insuring an asset as well, for the same sort of thing, that immutability plays the same sort of part. If you have a set of diamonds, for example, and you need to verify
in this specific space of where reinsurance brokers and reinsurers, I think somebody termed this competition, right? Because they compete for a market share, but they also cooperate when the claim happens and the risk happens. It's a bit of a unique competition word, if that's a kind of heard, where there's a data sharing is mandatory, is very key, but also they have to protect certain angles to it. So in terms of auditability, it's very important to say who has agreed what terms, what wordings, what subjectivities, who have signed. There's a digital signature goes on in blockchain. So you don't need to, if I send a submission through, I don't need an acknowledgement back from the participant saying I've got the submission, because the protocol handles it. So the protocol handles with the fact that I have sent it and I know the fact that they have received it. So these are some of the audit points. And in fact, you can turn around and say, I put a code submission through. I want to know which of my trading partners are responding in a timely manner. Actually, am I getting my codes in a timely manner? Am I getting the performance of the portfolio? I can look at the real-time management of my exposure, the capacity. So all these are the byproducts of having a system which is underpinned by a distributed ledger. It happens to be. It's like how cloud technologies was about 8-10 years ago. If you think about cloud technologies, people used to make a proof of concept at that time, which has come a long way now. I think it's in a very similar scale, but I think it will not take 8-10 years now, which is already there.
I have a question for you guys. In terms of the platforms that you're describing for insurance and reinsurance, are they mediated by a public chain, or is it a private chain? And that is to say, is there a central actor that has control over the governance or the way in which that chain develops, say the ability to change an entry or amend something? How does it work now, and how do you see it going forward?
So where we are focusing is on a private permission blockchain. So we are not into this public blockchain space. So because of the reinsurers, brokers, insurers, they already have a level of trust now. Public blockchain is where you have zero trust with the trading partners, and you need a consensus mechanism to get the transactions through. But here we are focusing on a value-focused group of entities who already have a business network today. It's just that it's been transacted through traditional systems, and hence the byproducts of the inefficiencies that we have today. So what our focus is to connect these entities on a private network blockchain and permission, so that they coordinate the data, they share the processes, and they share the communication to create the single version of the truth. We don't use tokens. There is no cryptocurrency in our platform, because what we focused on is a low-hanging fruit, which is an operational friction which exists today, which needs to be solved today with a very minimal hurdles to get involved. So this is we're not into the crypto tokens yet.
Understood. And just a follow-up to that, where you have a private kind of chain, and then you've provided this solution, which is great because it brings together people and creates efficiencies, all kinds of operational efficiencies. Do you see that there is an opportunity for a bunch of coders with a great idea to set up a public chain which has its own economy and tokens to come in and offer a different solution? Is there, you've come up with something already, which sounds great, but what do you think the interaction in the future will be between the private chains and the public kind of thing that's happening?
So in the space that we work in, the commercial insurance space, obviously there will be multiple multiple business networks.
Yeah.
There's a Bermuda network here, so you could look at a Bermuda insurance authority could be creating the governance for that network, and there could be a London-based network. It could be a Lloyd's. It could be which is gone by Lloyd's, or it could be a Singapore network. There is a level of interoperable transactions that may happen, but that is still within the boundaries of a private network.
Gotcha.
Because it's still a business network. When I don't see how the public chain network can come in, because then it comes to a zero trust again. So I think that's a different offering totally. So in the commercial insurance and reinsurance space, in the B2B environment, it's purely the different networks will be there, but they will have to collaborate. I think somebody mentioned about supply chain as a great example. So if you look at the ecosystem, insurance is just one angle to it, right? Because it's a customer-led. Everybody needs a payment, everybody needs an insurance. The insurance needs an insurance broker. It goes off a chain like that. So, but within that insurance boundary, there'll be multiple networks, which is the business networks.
Thanks. Ari, from your point of view as an underwriter, when you're looking, I mean, your data is what you trade off, right? That's your proprietary information. And when you look at even the potential of putting it somewhere that is not, in cold storage under your bed, wrapped with a ribbon or whatever it may be, or something more secure than that, perhaps. What do you look at it when you're looking at it and you think, is that something you would be happy to get into?
I think that's a great question. With the new GDPR and all the other regulations that have come in place, it becomes slightly tricky where you place your data. But I think like many of the insurers today use clouds. Now cloud and like DLT or blockchain, these are different concepts, but even in a cloud, it sits outside your perimeter somewhere else. So I think that should work in theory at least. And in blockchain, I don't think like like if you're using DLT, that's a slightly different probably technology, but I don't think like the blockchain itself, like it's encrypted, and I don't think it's hackable. I mean, at least the chances of hacking is quite low. But at the endpoint level, where the data sits, maybe with us, like everyone is vulnerable, and if an insurer gets breached, then the data can be out in public. So it's a matter. I think it should be okay overall.
That raises a lot of liability issues, surely. If you're putting it out there from an insurer's perspective, there's a lot of risk there.
Yeah, in my experience, so because I travel in this space where I represent some startups and some VCs and some carriers, the recent trend has come for people coming that operate in this space that are just looking to buy insurance. And there seems, what I've seen, and again, I can't speak for all carriers, and some of these are from the States, is there's been little appetite for writing even what would otherwise be kind of just general coverage, whether it's the D&O, the cyber in particular, the theft, the market. Again, in my experience and who I've gone out with my clients, it seems to be a little tight at this point where they're not looking to get in it, because probably for a lot of things we were talking about today is, and it's probably smart underwriting, is do we fully understand it? Can you explain it to us? Can we quantify it? Then the fact that some of these companies are so new, there's no loss history there to try to figure out how exactly to price it. So we've had recently a number of crypto companies come to us and say, if we could find some insurance, it would really help us with the SEC. It would really help us with the issues that we're having. It would help us with funding. And that's still not really there, at least, again, for my clients and the carriers we're out there for. I think because of some of the dollar issues, and then again, that the liability, if there was a theft or this did get hacked, it could be astronomical what the loss could be.
I mean, it's the same as the cyber, as the accumulation risk is.
Are you talking about the ICOs?
ICOs.
ICO is a slightly different variant of the cyber risk, because there are actually two very large parts of the risk, in my opinion. Probably you have a better sense, and feel free to jump in. I think definitely the hacking, like if they raise some money using Ethereum or Bitcoin, if that gets stolen, that becomes quite a large risk. Then another risk exists, which is quite large, significant, but that's not coming from a cyber standpoint, but coming more from performance. So what's the chance that you would actually deliver on your promise to deliver the coins? So that should also be insurable, in my opinion. Now, I don't think there is too much of insurer appetite for that, but I think it might be possible to create some sort of self-insurance or some sort of like a captive solution in a jurisdiction which will allow something like that, and that can be underwritten based on how the network looks like where they have stored their cryptocurrencies, the fundraise, and who is creating the coins, like who is coding the tokens, for example.
You say the same?
Yeah, I think there aren't any products out there seemingly, but one that really interests me is the concept of custodianship of tokens. It is an intractable part of the crypto economy. When you create a new public chain, there are people out there who have very big ICOs and they've created a public chain, and now they're frantically trying to build safes into their offices and stuff like that to put the keys to the 70% of the tokens left in the network, which may be worth hundreds of millions of dollars. So that is one solution. There are people with a variety of different solutions in how they custodian their tokens for ICOs. But this becomes a larger problem as we move towards security tokens. So the idea of not creating just a utility token, which is generally exempt from a range of regulation, but creating a regulated token that's traded on a regulated exchange, but is essentially a tokenization of any asset or anything. So you could securitize an Amazon share or a block of gold or an insurance contract, a property, anything like that. Really just what shares and stocks and other products like that are in the regular market. That is coming. Where and how the exchanges or banks or anybody, the funds, store and how they store those tokens is going to be a really big deal. So insurance is an essential part of making that economy work. If there are no insurance products to cover those problems, then it will not develop. And it's a better widget for capital markets. It's a better widget for innovation in terms of utility tokens. So it is coming. The insurance industry do the world a proper if we create products to cover particularly custodianship. Some of the other risks, being hacked, operational risk, all of those things, I think they're easier to quantify. But Andre, who was on stage before, has been doing some great work around the different levels of how you secure something. So you might have really cold wallets, warm wallets, hotter wallets, and everybody requires like a different range of liquidity to actually make their business work, be it a bank, an exchange, someone trying to be a crypto custodian, or a fund in our case also. So having insurance for that makes those businesses work, and without it, I don't think we can really move forward.
Another interesting use case of cryptocurrencies might be if it can be used to inject liquidity in the insurance liabilities. So, for example, if there's an ILS fund which is set up based on cryptocurrencies, then can that asset class be tokenized using security tokens, which is fully regulated in a proper jurisdiction, and can it be traded? In that case, you could inject liquidity, and at the same time, probably some of the much lower rate online deals can be handled in that situation. And I think that can in future become a possibility in maybe next 5-6 years.
I think that in 6 months, I could take any insurance contract and create tokens around it, and there'll be an exchange out there that would likely trade those tokens. So security tokens exchanges, they're coming very, very quickly. The regulatory framework is generally there. Maybe cost 120, 150 grand to go through the offering process. So yeah, it's fast.
Oh, well.
And I mean, that liquidity,
that'll
create a set of economies which I don't know what they're going to do.
So in a sense, if I just break down the insurance firm into 3 larger components. So the 3 large facets of an insurance firm would be operational, meaning distribution, operation, claims, and all of everything that is related to operations. Then you can break down the underwriting and risk selection into a different bucket. And the third is the capital raise and how you manage capital. So essentially, if you have blockchain and AI and cryptocurrencies, essentially you have disrupted all the three facets of insurance, of the insurance and insurance business. Mm-hmm. If you can punch in liquidity, then that really is a game changer. And at the same time, if you have an AI which can do a very large portion of the risk selection, and if it kind of augments into the human underwriters and makes it more smarter in terms of decision making, and if you can use blockchain to create operational efficiencies, then I think what we are looking at is quite the blueprints of a future insurance or reinsurance firm, how it might look like, pretty much.
Can I just take a last point? I know we keep saying blockchain it makes operational efficiency within the insurance organization. So blockchain is not for one organization. I can't come and sell a blockchain solution to one reinsurance company. It is a network participants who participate in that chain. So it is a benefit not just for one insurance company or reinsurance company. It is for everybody who is transacting with that insurance partner, insurance trading partner. So it's an economy of benefits across the ecosystem rather than is for one insurance. That is a different game changer to within a silo. So I can't fix a blockchain. I can't fix an operational friction which exists within the organization. I don't think it helps there. It's where the coordination of happens, which you don't have control about because it is stemmed from another trading party from somewhere else. So that is when actually the blockchain solution helps to make operations. I just want to say how the efficiency is brought about is no double keying of the data. When the data goes into the network, everybody gets an instant reflection of that state of the data, the fact. So everybody sees one version of the truth. So there's no reconciliation needed. There's no data collaboration cleansing that needs to happen. When the claims or when the payments are come, everybody knows who has to pay what currency, when the installments needs to come. So this is an efficiency gain across the ecosystem of participants, not just for one insurance company. Just need to put that in context.
Yeah, and that makes sense. And what I was saying earlier, I guess the question I have, or what I try to grapple with clients is the implementation of that. You're right. So you have a number of parties, which I gave the example earlier. You have the insured, the cedant, the broker, this and that. It's hard enough to do it internally in one company, the buy-in, but now getting all these various parties and then to say, okay, this is what we're going to do. This is the rubric we're going to start operating under, and we're all going to start now. And we're going is it something that can be rolled out and parties can get in over time, or is it something? Do you think that? How does that implementation work, I guess?
Okay, so the way we're looking at it is that imagine there is a business network already there. So broker puts a marine line of business. He works with 4 markets already. So they've got a network there. So by connecting them on a business network like blockchain, it allows them to operate in that value-focused consortium or the kind of ecosystem. But somebody needs to have an application owner. There should be a governance of some sort. There should be somebody to say, yeah, now you're on the network. So in the case of say Lloyd's London Market, Lloyd's could be one of the governance participant of that network. They could say who can come on, which syndicates can come on the board, and they could define the rules, the wordings, the framework in which the trading can happen. In this environment, I would assume that there will be a Bermuda regulator or some kind of authority who actually governs the onboarding of the new entity. But it has to start small somewhere. It has to prove the value to some handful of trading partners who are championing or innovating to prove this. So this is one of the key reasons that our platform allows to define the KPIs and run a 2 or 3 months pilot with the focused 4 or 5 trading partners for a given line of business, put the transactions through, and compare the KPIs as opposed to the current transaction, current operational metrics, and then that gives a good headache at that time to say, right, actually we got the operational efficiency that we talked about, we got the head, but actually then we could influence the market governance to create, to bring more trading partners on board. But then becomes a regulator can come on board. They could watch what's going on in the transactions. There could be more compliance-related entities can come on board. But the key thing is we don't have millions of transactions through the system in insurance, commercial insurance world. So what we have is something which can cope with the volumetrics and the performance and scalability of the commercial insurance market, unlike banking world, in which case it's a different story.
I just want to open up the floor to any questions. Put your hands up if you've got anything comes to mind, springs to mind for the panel today. Anyway, we've got a couple down the front here. There's a microphone coming.
So we touched briefly on theft.
Just 1 second. There's a microphone right behind you. There we go.
So we touched briefly on theft. I don't know how familiar any of you are. I assume you are all very familiar with Mt. Gox. What sort of results might securitized reinsurance products of some form, how could that be impacted in the same way by theft? I was very disappointed that Mt. Gox did not have insurance at the time. How does an underwriter view that from a cybersecurity perspective?
So I think what you can underwrite something like theft on is how they're really storing the funds that they have raised. Are they storing it in a cold storage, or they're using a hot wallet, or what are the protocols in physical security of the tokens? Someone can still like take a gun and break in and steal all the money. So like what we essentially do is we have our own cybersecurity experts who would go and audit the system and see like what kind of protocols are there in the space. And based on that, you could like rate that kind of, and we got a significant amount of data on the historical thefts of cryptocurrencies and ICOs in particular. And from there, you can literally see what are the top vectors that has been trending in recent times, and if based on that, you could definitely create a pricing for like something like a theft of the fund.
How does a network protect against bad actors on the network? Yeah.
It depends on how you've stored the cryptocurrency. So, for example, if you have cold storage, that's the best possible way you could take it out of the internet. So it's air gapped. So that becomes the best possible way to store it. But again, where are you storing those coins? Are you storing it at a bank, or you're storing it in your bunker, or where are you physically storing it in that case? So that's one of the things. Or if you're storing it inside your inside your network, how well is your network protected? So those kind of like you have to do a security assessment of the firm which is raising the ICO.
I think we had another question just over here. Just a couple people down. There we go.
This might be a silly question, but if everybody has, say, access to the network, is part of the hesitancy of maybe creating this blockchain, say, for the reinsurance industry, the fact that, say, from a KYC perspective, everybody will have access to everybody else's client's KYC, and they could maybe go check another, say, reinsurer's client list and say, oh, let's approach that particular client so that we can try and steal their business.
No, I think you got it wrong. So I think Dave mentioned earlier in the call. So it's a business network, and everybody. So suppose if 4 or 5 people are part of the contract in that network, even though the network has 25, 30 participants, only those 4 or 5 participants of the contract will really have the footprint of the data. So this is the default definition of blockchain that you've heard about, public blockchain, where everybody gets some sort of data, everybody gets to validate the transaction, so everybody gets to see the data. But again, ChainThat is focused on where there's a level of security where if a contract or a claim is created or comes in, it only those participants in that contract within that network will really have the visibility of the data. So it's not like everybody gets to say, everybody say, no, that's definitely not the case. Just to illustrate on the earlier option about, we have created lots of blockchain is just technology, but the insurance videos on our YouTube channel, which actually enables blockchain from a business perspective, which kind of explains some of these use cases about how the multi-party syndicated placements, the claims, the accounting and settlement. I would recommend you actually have a look at those videos that really sets that at the business context level and also the technology level. Helps.
I just want to help clarify one thing for you. On the blockchain, you have cryptographic keys. There's a public key and a private key, right? And so only the people that have the key to unlock the data will be able to see that data. So even on the public chain, unless you have the key to actually get the data, it exists. You know that it's there. But I don't know that it's John Smith or very similar to like the token that's here. Only Visa or MasterCard can actually see the data that's on there. No one in this room, ideally, can be able to actually see that.
I know some long lens cameras up at the back there. I might be able to help out. We had another question was right in the middle. There.
So, as part of all of the blockchain solutions that you're bringing, do you have a sense yet of how much you're going to actually save, how much a carrier or a broker or someone involved is actually going to save on the overall loss rate, expense ratio, and is anything been done?
Yeah, so yeah, we have done a lot of work on the business case benefit on this across. Again, it kind of varies between the value chain, how you use blockchain, right from placement of risk, pre-placement data, and then the accounting and settlement, and into a claims workflow where there's a big friction again. Our estimation is about an average 30% cost savings across not just insurers, even the brokers, depending on which specialty line of business or which value chain in insurance you're applying, or you're applying across or not. We have a paper that we have written, which we're happy to share. It's on the London Tom website, which is again it's an industry paper, which also validates this assumption. B3I is another consortium which have again come out and presented their findings of the cost savings, which is again is along the similar lines. So yeah, there are different work around how much cost savings it can have. One is cost saving, one is time. The process faster, and we always forget customer end of the day. It's how faster we pay claims for the customer. So which is again another dimension to the benefit case that helps.
I think there's another element to that. The operational efficiencies of that product, I can absolutely understand, but there's much better ways to run business practices, and blockchain can help with that. Alternatively, in the public chain and outside of that, this is a hugely impactful technology for distributing trust and relationships, and you can bake in a whole bunch of preconditions and stuff into a smart contract. There are people actively out there trying to eradicate your entire industry and rebuild it anew. And they're really, really smart people with a bunch of good coders and some economic stuff going on. They are doing that across a variety of different industries. Where there are intermediaries and trust issues between central actors and large numbers of participants, where there need to be verifications or certain preconditions need to be met, something like that. So if you think about advertising and marketing, the ad world, there are people building tools to wipe away the agencies. So there are people trying to come up with new business models, and they are, to be honest, no one's really like out there in the innovation world in Silicon Valley trying now to build a traditional SaaS model company. They're trying to use blockchain to disrupt the major industries. And they're the smartest, most innovative people in the world. So these people are doing that. Alternatively, the incumbents, the industries themselves, they need to adapt, and they need to think about the impact that is going to have, because the people with the most to benefit from this technology is actually the industry itself, because it's not really very difficult. It's not a difficult technology to get your head around, and it's not very difficult to implement. And when you already have the industry in the palm of your hands, all you have to do is just refactor it slightly and insulate from that systemic risk. But there are lots of industries across the board which are going to pretty much go away in the next 5 to 10 years, because somebody will come up with a better version of that. And a lot of incumbent players are going to feel a lot of pain. So that's something that I see happening every day, a slow-moving train wreck across very many industries. And that's the public side. So I would adopt as much as you can, wherever you can.
We're going to unfortunately have to wrap it up there. We have a quick round of applause for all the panelists. Thank you very much.